28th June 2023 is a historic day in Indian stock market. Both Nifty and Sensex hit the record high yesterday. Hello everybody and welcome to Synanomics, the money machine. Yesterday was a historic day for India and I'm going to cover that today. Yes, Nifty 50, which is the top 50 companies index, hit the record high of 19,011 yesterday. Sensex, the other index which tracks top 30 companies, also hit the new high of 64,000 yesterday. Let me put things in perspective for you. Sensex was started in 1980 from 100. Any index starts from 100. So in 43 years, it has given 640 times return. Yes, you heard that right. 640x return. Nifty, on the other hand, was started in 1992. So in 31 years, it has given 190 times return. Yes, you heard that right again. 190x return Nifty 50 has given. Well, this makes India the fourth most valuable market in the world after USA, China and Japan. Also, Nifty 50 is the only index that has given 8 consecutive years of positive return. From 2016 till now, it has given positive returns. If you look at the other indices of the world, for example, S&P 500 has given 5 times from 2003 to 2007. Dow 6 times from 2009 to 2014. And both DAX and Nikkei of Japan have given 6 times as well from 2012 to 2017. If you look at last 3 months return, Sensex has given 10%, Nifty has given 11%, S&P 500 has given 10% as well. Australian index ASX 200 has given roughly 2%, and FTSE of UK, FTSE, that has given 0.4%, 0.8% actually. So from the last 3 months return perspective, Nifty 50 is the highest. Well, why is like that? Why is this India story going? And I have covered that earlier as well. There are 2 key factors to that. Number 1, Indian economy is growing the fastest in the world. Just now India announced last 1 year's GDP growth of 7.2%. IMF has actually forecasted that India will grow at 5.9% this year. And that's the highest in the world. And not only that, IMF thinks that India will continue to lead the world from the growth perspective for next 3 years at least. And that's creating the buzz and changing the whole outlook about India. The second most important factor is also the foreign investment, guys. The foreign investors are now interested in India. Last year, Indian companies have raised $19 billion by selling stocks. And this is much higher than what Germany, UK, France and Japan have done last year. Not only that, the total FPI investment, foreign portfolio investment, has been $11 billion this year. And if I look at the total, which is called FDI, foreign direct investment, and that is the direct investment an individual or a company does in India. In the last 23 years, from 2000 to 2023, the total investment has been $919 billion. Yes, you heard that right. And guess what? 65% of that, which is around $600 billion, to be precise, $595 billion, has been made in the last 9 years, from 2014 till now. So there has been solid interest of foreign investors in India. Going forward as well, Morgan Stanley index, of which tracks the emerging market, they are actually planning to make some changes. They think that probably there is a rumor, let's call it rumor at this stage, that they want to put Korea, South Korea now, in the developed economies. And that means there will be heavy influx of funding in this emerging market, which is tracked by Morgan Stanley World Index. And that will pump more money in Indian stock market. So that's going to be another solid story going forward. Now, where from now, from here? Is it the end or what it is? Before we get to that point, let's look at the journey overall of Nifty. And the journey is very interesting, guys. Let me put forward to you. Nifty actually, even though started in 1992, it hit 4,000 in 2006, December. In 2007, November, it actually touched 6,000. Yes, you heard that right. 50% growth from 4,000 to 6,000 in 1 year. And guess what? After that, the economic financial crisis started, Lehman Brothers issues, etc. And Nifty took 7 years. Yes, it took 7 years to reach from 6,000 to 7,000. The Nifty reached 7,000 in 2014, May. And again, in 3 months' time, it actually hit 8,000 in September 2014. So it took 7 years to cover 1,000 and 3 months to cover the next 1,000. And guess what? Again, from 8,000 to 9,000, it actually took another 3 years. In 2017, it actually reached 9,000. And from 17 to 2020 December, it actually hit 14,000. Yes, 5,000 points in 3 years. And this included Corona time, guys. Corona was another interesting story from stock market perspective. When Corona hit the world, Nifty dropped to 9,000 in March 2020. And from March 2020 to December 2020, it had a journey of 9,000 to 14,000. 5,000 points in roughly 6 months, 8 months. 2021 was the fantastic year in the history of Indian stock market. And I personally, in my 20 plus years of investing career, have not seen an index move like that. From December 2020, when Nifty was at 14,000, to October 2021, Nifty hit all-time high of 18,887. Yes. Amazing. But guess what? It has just hit or crossed 19,000 yesterday. So from 18,887 to 19,011, roughly 125 points. To cover 125 points, it took 21 months, guys. And that's what stock market is all about. That's why Warren Buffett says, stock market takes money from impatient investors and hands it to the patient investors. Yes, this whole journey testifies and substantiates actually the theory that you can make money in stock market if you have the knowledge to understand the companies, courage to go and buy, and patience to hold. But hey, what's now? How is the road looking forward? Let's look at that. Actually, as I mentioned to you, it took 21 years for Nifty 50 to add 125 points from 18,887, which actually it achieved in October 2021. So if you look at from the growth perspective in the last 21 years, it has done nothing. If you look at the price earning ratio of Nifty in October 21 was roughly 22, 23. Whereas now it's sitting at around 17, 18 like that, because all these companies gave the profit and they actually had a good profit run in the last 2 years. So from the price earning perspective, Nifty 50 is still very cheap. And let's look at the number, guys. This year, year to date, this calendar year, 2023, Sensex has given only 2% return. Yes, for the 3 month it has a great return, but for the whole year, year to date, it's only 2% return from Sensex. Nifty has given 4.2%. Whereas the US index S&P 500 has given 14% return year to date. Yes, S&P 500 is ahead of the race if you look at the year to date numbers. Australian index ASX 200 has also given 2% return. And if you look at FTSE of UK, that has given negative 1% return. Yes. So from the return perspective year to date, it has gone nowhere. 2% and 4% is nothing, guys. And that's the beauty of that. That shows the light in the tunnel. So the bull run has just started. And this will continue at least for next 2 to 3 years' time, unless something dramatic happens. Let's look at the other indicators. 61% of Americans invest in stock market directly, other than their 401k. 50% Australians invest in stock market directly, other than the superannuation and their primary home. And also 16% Australians invest in the international stocks, guys. Good. Whereas in India, only 3% of the households invest in stock market directly. Yes, India still is a country of investors who buy property and gold. Only 3% households are in stock market investment. The DMAT index, the DMAT accounts, which is the dematerialization account, where it's pretty much like the account where you keep the stocks, shares. So if you need to buy shares in India, you need to have a DMAT account where all these shares will be held electronically, just like any other country. The DMAT account has actually grown from 40 million before COVID to now 120 million accounts. There's a huge growth of this DMAT account, which indicates that now a lot of retail investors are coming into the market. So other than the foreign fund, there has been an influx and the inflow of the domestic fund as well. And that's going to fuel this market further. So if you have not invested in India, maybe it's time to think about it. You can directly invest. Indian government has simplified a lot of rules now. Or you can buy ETFs. Think about it. Well, these are not my recommendations. Please consult your financial advisor before making any investment decisions. Guys, if you like this kind of content, don't forget to share and subscribe. Remember, the primary aim of Sinhanomics is to create financial awareness so that you can act on it and make money. With that, I'll come back again with a new story. Till then, it's a goodbye from your friend, Pankaj Sinha. Bye-bye.